So how does Kaizen manage risk differently than other leveraged insurance strategies if we weren't to look at it that way?
Great question. It's really about specifically the design in terms of the relationship between how much your client is putting in and how much we are leveraging. I mentioned a bit earlier that the client is funding roughly, depending on age, 50% of the premiums years 1 through 5.
Hmm.
That will look different for everybody, Brendan, based on your age, based on your rate class, et cetera. So what we're doing is we're stress testing every design based on the two worst 15-year histories the US economy has ever seen. High interest rates in the 1980s and underperformance of the stock market from 1930 to 45, Great Depression.
Hmm.
We start with that underperformance. So we're not trying to make things look great on paper or overpromise. We start with those two stress tests, and those stress tests are what dictates how much we can or cannot borrow based on that client's age. Every Kaizen design has to do that, and that's what makes it unique. Where other platforms, you may just be borrowing 90+% of the premiums, and the client may just be paying interest on the bank loan. I don't want to say there's anything, quote, wrong with that, but it is a significantly different risk. You may have liquidity issues and collateral needs for 10, 12 plus years on that. So that's the fundamental difference is we're leveraging smaller amounts based on a stress tested amount to ensure that your client never is on the hook for the bank loan. They're not signing those typical loan documents.
So when people hear leverage, they think about debt, right? So you're saying that they're not
Yep.
on the hook for those
Right.
bank loans.